UnitedHealth Group Stock, ticker symbol UNH. Is this the best dividend growth stock to buy right now? This stock has gone up and down quite a bit, but bottom line they are down 3% on the year-to-date chart, while the overall market, in this case the S&P 500, is up roughly 12%, so that's a big difference. On the 14th of April, UNH presented quarter results where they beat on EPS and revenue. For the upcoming earnings, almost all analysts expect a miss. From a dividend point of view, things look pretty interesting with dividend yield at 1.34%, which is not that high of course, but payout ratio and the growth numbers look really good, being one of the reasons why people love this stock. But does this mean that UNH stock is a buy at current prices? I'm very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So, what does United Healthcare do? United Health Group is one of the largest health insurers, providing medical benefits to 50 million members globally, including 5 million outside the US. When we dive in the most recent earnings report, we see that revenue was reported at 91.9 billion, growing 15% year over year. And to me, this looks pretty good. Earnings from operations grew 16% year over year, also looking really good. Net margin decreased just a tiny bit, which is not that bad. But keep an eye on this number. Cash flows from operations for the first quarter 2023 were 16.3 billion, or 2.8 times the net income. Excluding the impact of April's CMS payments received at the end of March, adjusted cash flow from operations were 5.1 billion, or 0.9 times the net income, consistent with the company's outlook. In total, the company returned 3.5 billion to shareholders through dividends and share repurchases. Return on equity was reported at 28%. And when we dive in a more detailed view, we see that United Healthcare represents 70 billion and Optum represents 54 billion. Eliminations reported at minus 32 billion. Operating margin is at 6.2% at United Healthcare, increasing a tiny bit year over year. But Optum has decreased in operating margin from 7.3% to 6.9%. And now that we know more about the company, it's time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe to my channel to receive multiple analyses every week. And also join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue with diving into the fundamentals. UNH is a 466 billion market cap company. PE ratio is at 22, which could indicate that they are around their fair valuation right now. Later in this video I will show you my 3 price targets for UNH, so make sure to watch until the end, because PE ratio is only telling a small part of the full story here. Revenue is at 333 billion, and in this graph we see that revenue went up really nice and steady. Over a longer period of time, margins are going up, which is something that I really like. EPS is going up big time and growing alongside the revenue and margins. Price to sales ratio is at 1.41 right now. Over a longer period of time it's going up, which is something that I don't like. However, 1.41 is still a great number, so nothing to worry about for now. Price to book ratio is pretty much the same story. Nevertheless, keep an eye on the current number. I prefer a lower number here. Analysts expect double-digit growth for the EPS in the coming years, which is very nice. For the revenue it's pretty much the same story, but slightly lower numbers after 2024. They expect to see high single digits growth for the revenue. Return on assets is sitting at 8.1%, which is below my 10% minimum, but it's nothing to worry about for now in my opinion. Return on equity looks really good. And the most important number, return on invested capital, is sitting at 13.5%, which is a really good number. Next to that, it's also above the 5-year average by a small margin. Nevertheless, it's looking really good. Current ratio is at 0.81, which looks pretty good to me. For this type of company, I prefer a number below 2. Total debt is sitting at 70 billion, and I prefer companies that can pay down at least a third of the total debt with the total cash position. Right now, total cash is sitting at 46 billion, so they can pay down a big chunk of their total debt, which is something that I really like. But it's very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, pay dividends, and all other things. And in here we see that free cash flow is going up quite nice and steady over a longer period of time. A thing that I love about this company are the shares outstanding. It's going down in the long run. It means when shares outstanding are decreasing, it increases your ownership in the company, increases the EPS, lowers the PE ratio, and makes it easier to maintain and increase the dividends. And since we're talking about dividends anyways, dividend yield is sitting at 1.34%, which is a decent number. Annual payout is at $6.6 and payout ratio is at only 28%. I prefer 50% or lower, so right now they have roughly 72% left in cash to buy back shares, pay down debt, acquisitions, research and all other things. The 5-year growth rate is at 17%, which is a great number. On top of that, they grew the dividends for 13 years in a row, which is also pretty nice. Payout ratio is a very important metric with dividends. It tells you if the dividends are safe. In here we see over a longer period of time, payout ratio is always between 24 and 30%, which is a really good number. In this graph we see the expected dividends in 2023, 2024 and 2025. Of course this is an estimation and can be highly impacted by results, but it gives you a rough indication. It's expected to grow at roughly the same numbers in the coming years as historically, so this looks really good to me. And overall the dividends look pretty good to me as well. But how about the historical returns? I decided to compare UNH stock with the overall market, in this case the S&P 500. Next to that I added some other competitors like ELV and HUM. On the 5-year chart we see that UNH stock has easily beaten the S&P 500 by quite a margin. UNH returned 120% including dividends, while the S&P 500 returned 70%. The other two competitors also beat the S&P 500 on the 5-year chart. On the 1-year chart it looks pretty different. UNH slightly underperformed the S&P 500 and HUM had the highest return with 16%. On the 6-month chart it's the S&P 500 with the highest return. All the other stocks had a negative return. On the 1-month chart it's again the S&P 500 with the highest return. So bottom line, UNH has beaten the S&P 500 and some competitors big time in the long run. But most recently it doesn't look good for UNH. So what about the current stock price? Does it mean that UNH stocks is a buy right now? Well, let's check the 3 price targets that I created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with revenue growth. For the revenue growth I'm filling in 9%, 10% and 11%, since I think they will increase the revenue at the same numbers versus historical averages. Next to that, it's also based on the analysis expectations and the current outlook. Profit margin I'm filling in 6, 6.5 and 7%. And for the free cash flow margin I'm filling in 6, 7 and 8%. For the PE ratio I'm filling in 18, 19 and 20. It's a big company with great fundamentals and there is still some growth left. However, I don't want to overpay for the growth. For the price to free cash flow I'm using 16, 17 and 18. Because free cash flow was incidentally increased recently, which I want to factor in. My desired annual return is 12.5%, since I can get an easy 10% average annual return with owning an ETF. Right now UNH stock is at $499. I hit analyze and we see a few green numbers. We have a low price target of $411 to $422, which is a big drop from the current stock price. We have a mid price target of $535 and we have a high price target of $641 to $683. To me, the mid price target is the most justified here, indicating that they are undervalued by a decent margin right now. My final conclusion on this stock is that I started to like them more and more. The business is doing great, fundamentals look really good, and they are still capable of growing at high numbers. Dividend yield is not too high, but the growth numbers and consistency make up for that in my opinion. I was paying attention to this stock already, but to be honest, I think I will put it on my buy list right now. I must say that I would love to enter at lower prices, so I'm waiting for a drop. But whenever it hits $460 or $470 for example, I think I will open a position. Of course, I will analyze them first to see if fundamentals have changed. So for now, I'm just waiting a little longer, but I definitely like the stock at current prices. But remember to always do your own research and never fully trust on what I or other YouTubers say about the stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.